First off, when we look at a company, the first thing really is to understand what sort of a business is it. And the really fundamental characteristics there is you want to know what kind of returns are they getting, high or low returns, and then what's their ability to reinvest to grow those returns. Then you get a sense of what the underlying economics of the business are that they're working through. Now, an ideal business is one that can access high growth rates without taking on too much risk and can self-fund that growth because they've already got high returns. And then you need to see that backed up by a great management team, a strong balance sheet, good risk culture, things like that would also be part of our due diligence. I don't think you can bring it down to one, but I'll bring it to two, which is the Warren Buffett, the horse and the jockey. You've really got to have both of those. You've got to have a great horse, which is a business that's operating in a good industry where it can generate high risk-adjusted returns, but you wouldn't invest in that sort of business, no matter how great it was, if you didn't have faith in the capability of the management team and if you didn't trust them. We are firm believers in Wisetech. We first invested in them a year pre-IPO. That gave us a long time to get to know them, understand the business, understand the management team, and we really like the returns that they generate because they're a software business. So it's not like an industrial company where if you're going to sell twice as many widgets, you have to double the size of your widget factory. Software being a digital good, you can sell more at very low incremental cost. So the cost that Wisetech is incurring is to improve the business, to create more capability, to improve their geographic reach and make the offering that they have to logistics providers that much more compelling. And that is all being driven by Richard White, who is the founder and the CEO of that business and has done a great job for 20 years to grow that business and direct it to have the competitive advantage that it's got now. So a lot of it comes down to the time frame of your investment. So the growth was a little bit lower than the market was expecting in February. We're not terribly fussed by this because we think this is a company that has an enormous pathway of growth ahead of it. A lot of the investments that they're making now are going to take many years to pay off, but we can see that they've got the potential to maintain their leadership in this field and grow these highly cash generative returns for many years into the future. So we think with any business, the growth rates are going to vary a little bit from period to period. Obviously, we'd be concerned if we thought there was some structural reason or they were losing market share or they'd been leapfrogged by a competitor, but we don't see any of that, and so we're quite confident in the longer term growth potential of the business.